Okay, Apple's fiscal second quarter results are out. Shares are down about 6%. In this video, we're going to talk about the updates that we made to our earnings model for this quarter. And then after that, we're going to talk about the share valuation. So if you take a look at the press release, you can see they missed the mark. They missed consensus estimates, and the estimates for iPhones were below what we had expected in our model. And the guidance for next quarter was a little bit disappointing too. So that's right here. So what we're going to do on the right-hand side of the screen is the updated model, which includes this quarter's results, and it also includes the additional guidance that management gave us so far. We didn't get the full details because the earnings call hasn't started yet, but we'll listen into the call after we're done this video, and then if there are any additional updates to the June quarter, we'll make those after the fact and post another video, or at least update the earnings model and make it available on our website. And if you'd like to download our updates, including the results from today, you can visit our website, gutenbergresearch.com, click on the Models tab, scroll down to the Apple model, and you can see we put this little comment in here that basically is saying that we've updated our model after the press release, before the earnings call, and here it is. So you can just click the icon to download the model. Close that. So let's get started. So what I'm going to do is, on the right-hand side of the screen is the updated model, and I'm going to open the model from yesterday on the left-hand side. And let's just let's sync this up here. So bring this down. Okay, so you can see that prior, in yesterday's version, this was all estimates and consensus estimates and management's guidance for the March quarter and for the June quarter. And now you can see in the updated version, we have actual values in the March quarter and estimates in the June quarter. So let's scroll down, and you can see that on the sales basis, the street was looking for about $52 billion in total sales, and it came in short of that at 50.5, and that was the bottom end of management's guidance for this quarter. Gross profit was expected to be between 39 and 39.5%, and it actually came in at 39.4%. So gross profit held up okay. Operating expenses were expected to be $6 billion, and that was the low end of management's range, and they came in a little bit below that at 5.9, but that's nothing to celebrate because it's on a lower revenue base. Then other income came in lower than expectations, but that's fine. Not a huge portion of earnings overall. Provisions for taxes were expected to be 25.5%, and they came in at 25.6, so not a big deal there either. Overall, the street was looking for $2 in EPS, diluted EPS, and the final results were $1.90 a share. So overall, not a great quarter. Let's take a look by segment. So we're going to scroll down to the details where we have the units sold. So let's take a look, starting with the iPhones. We had estimated 52 million iPhones sold, and it was actually 51.193, so it missed our expectation. Total Max, we had expected 3.9, and Max came in at 4.0. And total iWatch, so we don't actually know what the total units sold of iWatch. In fact, I should highlight this blue here. But we break out the other category, and that's basically what we came up with is 1.7 million iWatches sold. But again, this is just our estimate, so we don't know based on the actual results here. And then we look at the average selling price for iPhones. So it came in very low, and this is probably due in part to the strength of the US dollar. So last quarter, the average selling price per unit was $691. We had expected $682, and we actually ended up with $642. So very weak showing on the average selling price for iPhones. Then if we take a look at the Max, that's not a bad figure there. So we were looking at $1,250 per Mac computer. It came in at $1,266. So not a big move there. And then for iPads, we were looking for $425 per iPad. It came in at $430. So that was in line too. So for the June quarter, we didn't actually adjust our estimate for iPads or Macs. We left it at 425 and 1250. But for iPhones, we had to bring that average selling price down because we were originally anticipating $668 per iPhone. But just based on this quarter's results, it no longer seems that that's going to be realistic. So we brought that down to $642. And then just keep in mind that in the September quarter, towards the end of the quarter, they'll release the new iPhone 7, so that ASP should start to increase again, with the majority of those sales coming in the December quarter. So you can see we left our December quarter estimate of average selling price intact, unchanged at this point. And we'll just have to wait and see as time progresses how the iPhone 7 ramp goes and whether or not we'll need to change that. Okay, so next let's take a look at the guidance that management gave us tonight. Let's see here. It's right here. So they're expecting revenue between 41 and 43 billion, which is well below what the street was expecting for the fiscal third quarter. So the street was looking for 47.4 billion. So we to get back to that 42, which is the midpoint of the guidance that management gave us, we had to change our growth rate for the iPhone. So we brought that down to about a 20% decline in the fiscal third quarter. And again, we had already explained that we brought our average selling price down to 642. This average selling price might actually even be lower next quarter. So we'll have to listen to see if we get any commentary from management on what the expectation for average selling price is going to be for the next quarter, because they do have the iPhone SE, which could actually put a little bit more pressure on the average selling price since it's got a lower price point at $399. So hopefully they give some clarity on what their expectations are for average selling price. I'm sure the analysts will be pushing for that in the question and answer section. For right now, prior to the call, we'll just leave it at 642. So when we changed the growth rate in the ASP, we were able to get back to the midpoint of management's guidance at 42 billion. And then we set our gross profit margin equal to the midpoint of management's guidance from tonight. So you can see that they guided between 37.5 and 38% gross margin. So we have 37.75% down here. That gets us to gross profit on the income statement. Then this is sort of an interesting point here. So the guidance for operating expenses stayed pretty consistent with last quarter, between 6 billion and 6.1 billion. But it's on a much, much, much lower revenue base for the fiscal third quarter. So that's a little bit disappointing. And we actually had to increase both our R&D and SG&A estimates as a percentage of total revenue in the ratio section down below. So you can see if we go back to the model as it stood prior to today's release and scroll down to what we had estimated. So we had estimated SG&A in the fiscal third quarter at 8.8% of total revenue, and R&D at 4.1%. So we had to increase that to 9.3% for SG&A and 5.1% for R&D. So that was definitely pretty disappointing. That gets us down to the operating income line. Then for other income, management gave guidance of 300 million, which, last quarter they gave guidance of, I believe, 325 million, and it ended up being 155. So the guidance isn't great on this line, but it's not a huge contributor to overall earnings, so we're not too concerned with it. For the time being, we left it at what management guided to at 300 million. And then for the effective tax rate, we took the tax rate that management gave us at 25.5%. So that gets us to total net income of 7.5 billion for the third quarter. And then we just to get back to EPS, we had to make some assumptions about the share count. So management did announce that they were increasing their capital return program. So we actually changed our share repurchase assumptions in here. And also, since shares are down, we brought the average price of those purchases down as well. So let's take a look again at our earnings model prior to tonight's release, what the assumptions were in there. Okay, so prior to this release, we were estimating $4 billion in total repurchases at a repurchase price of $110 per share. So we brought that down to about $95 per share And for the September quarter, we brought that down to $100 a share, and we increased the total amount of the repurchases to reflect the fact that they're increasing the repurchase program. So we added an additional $2 billion for each of the next 2 quarters. So instead of retiring 36 and 35 million shares respectively, we estimate that they'll retire about 63 million and 60 million. So once we put those assumptions in for the share count, we get to a diluted EPS estimate for the fiscal third quarter of $1.38. And prior to tonight's release, the street was looking for $1.76. So well below what the street was expecting for our diluted EPS estimate for next quarter. So that's, it's just an overall disappointing quarter. So let's take a quick break here, and then when we come back, we're going to talk about the share price move in after hours. So right now, shares are down about 6% in after hours. Based on our model change, prior to this release, we were estimating a share valuation of about $106 per share, and now we're down to $95.25. So our model is predicting about a 10% decline in overall share price. And we can take a look at how we got to that. So this is a tier 1 model. So we value shares based on a 2-pronged approach. So the first prong is the price earnings multiple based approach, and that's in this section here. So you can see, if you scroll down, that we left the PE multiple used for valuation consistent with what we had prior to the release. The net cash per share changed slightly from prior to the release, and that's just a result of the new net cash balance. And the price from a price earnings multiple standpoint went from 96.50 in our model, or excuse me, from 103 to 96.50. Then if we take a look at the DCF, and you can see we also haven't changed the beta or the equity risk premium or the required return on equity or the weighted average cost of capital or our long-term terminal value growth rates. But the new valuation using our DCF approach is $94 a share versus $108 prior to this release. So that decline in overall growth rate that we're seeing based on management's guidance for next quarter is really having a pretty significant impact in our valuation model here. If you'd like to download this model and input some of your own estimates in these blue cells, you could run some sensitivity analysis for the next couple of quarters, or if you want to change the valuation metrics or change any of the assumptions, particularly in blue, you can download it on our website. It's available now. It's been updated for this quarter's results. So go to gutenbergresearch.com, click on the Models tab, and then scroll down to Apple and click the icon to download it. And like I said before, if there are any additional updates that come as a result of the earnings call, we're going to dial in now. We'll update this model again and have it available later on tonight on our website. Thanks for watching, and good luck with the rest of earnings season.